is this the single greatest deep value opportunity in the stock market right now? Today we are breaking down InMode. This stock is an absolute battleground. It's down 84% from its all-time highs in 2021, but if you look past the chart, the math is screaming by. Here is the reality. InMode has a market cap of roughly 900 million, but they are sitting on over 500 million in cash with zero debt. That means the enterprise value is only 400 million. For a company that has generated between 100 to 200 million of free cash flow every single year for the past 4 years, you are basically buying this money printing machine for less than 4 times its cash flow. Is this a value trap or the bargain of the decade? Let's dive into the fundamentals. And before we start, if you love finding undervalued stocks, smash that subscribe button for MoneyJourney. Let's get into it. So, what are you actually buying? InMode dominates a specific niche in the medical aesthetic market. They don't just do lasers, they own the proprietary radiofrequency technology famous for products like Morpheus8 and BodyTite. Their massive competitive advantage is that they bridge the treatment gap. They offer results close to plastic surgery but without the scars, anesthesia or downtime. This is used for patients who want results but are scared of the knife. Plus, their business model is very good. They sell the machines, which have high margin, but they also sell the consumables, the disposable tips used for every single treatment. This creates a sticky ecosystem with recurring revenue and gross margins and consistently over near 84%, which is unheard of in hardware. They are profitable, efficient, and their technology is patent protected. My investment thesis for InMode is very simple. It is a cash-rich aesthetic leader priced for zero growth, offering asymmetric upside if the 2026 macro environment normalizes. And since we don't have a crystal ball or cannot predict the future, if it is not in 26, it will be 27 or 28, and until then we are getting paid for waiting because they are doing plenty of buybacks. It is an investment thesis that it is a deep value opportunity. We are not used to this type of opportunities anymore, especially because InMode is actually a very good VC. It's not a great or high quality compounder like we are used to analyze, but it's a very good company with great fundamentals and pricing like it's going out of business, so at a really great price. Their revenue model, they sell machines. It's the biggest part of their revenue, 75%, but they have a consumables part that is very recurring revenue and high quality, and we love that part. And it's growing, and it's already 25% of their revenue. In terms of quality, it's macro sensitive because these platform machines cost a lot of money, so high rates has been a bear case for InMode. They are not selling, their revenue actually are down in 2024, and they are expected to be down in 2025 as well. But after that, with easing, they are expected to resume growth, which is a bull case for InMode. In terms of margin, great margins. Bear in mind, it's a capex low. So manufacturing, it's all outsourced, and even with that they have gross margins of 82%, which is very high margins with low capex, so free cash flow conversion above 90%, which is something that is very good. In terms of 2026 expectation, they didn't close the 2025 year, only on the next earnings, but for 2026 they are expecting resume growth. An upgrade cycle with easing could be a very good case. In terms of moat, I would not say they have a competitive moat. I'll talk about that later, but they have their cost switching, switching costs from their consumers, so they are some kind of competitive advantage. Their patents protecting their technology, and they are a leader still, so there are some good competitive advantage, but I would not say that is a big moat. It is a value trap, that's the big question. In terms of capital allocation, they have more than 500 million, so zero debt, and right now one thing I really like is they are starting to increase their buybacks, so that's very good news, because management are providing that we should trust on them, and since they are doing buybacks, they believe the company is cheap. So us investors should think the same. Unless you don't believe management or you don't believe this is a good price to buy InMode. Of course, there are key risks. Higher for longer. If rates don't go down, for example, it will be difficult for other physicians to buy new machines because it's higher costs for them. So leasings, it will be very difficult. We have, of course, this an Israeli company, so there are the conflict in the Middle East, of course, and tax. So if there are some changes into tax benefit for Israeli companies, that could be a bear case as well. In terms of catalyst for 2026, rate cuts, it's the biggest bull case for InMode, so it will be very good. Lower rates, higher doctor purchasing power. Returning to growth, if they resume growth after all these problems they have been facing the last 2 years, it will be very good for InMode. Maybe investor regain confidence on the company, and we could see the stock going up. But I hope the stock doesn't go up, and the reason is that because at this valuation and the cash they have on hand, it will be very creative for the shareholders, for the company to buy back their own shares. So I really believe this is a great price for InMode. So if I believe that, managers will do the same, and if you have a lower valuation, it will be very good for buybacks, and that is one thing I really like. But looking into the fundamentals, they've been growing, of course, even though in the last 2 years revenue is down. 2024 the revenue is down, and it is expected to go down 6% in 2025, but they are expected to resume growth 4% in 2026. But the tendency is to go up, and if they continue to grow and printing the same money, I would say net income of and free cash flow above 100 million, that will be very good. And InMode is very cheap, and we don't need to do a discounted cash flow to know that. But fundamentals, they are expected to resume growth. Revenues, it's not the best high quality, is cyclical, it depends on rates, but there are some part of the business, 25% of their revenues are very recurring, so that's very good. And we believe in the next cycle InMode could be a 2x 3x opportunity. They have investing in R&D, new products. They have really good margin, profit margins, 38%, so that's very good. Of course, they will have to face competition because these margins are other companies' opportunity. Of course, they will have to defend their moat or their competitive advantage. Right now, they have patents to protect, but it will not be there forever. They have maintained their profit margins. They have better margins than competition. Pricing power. That's a very hard question for me. I don't believe they have pricing power. With these margins, it will be very difficult to maintain. But if they could sustain their margins and their product, this could be a very good investment. But we'll have to look into that in the future. In terms of debt, they have no debt. They have high returns on invested capital. Management has a very good job. In terms of motor competitive advantage, I do believe they have some proprietary technology. There are IP, they are protected by patents, and they have some kind of high switching costs for their core machines that they are already in place. So doctors will have to use the consumables, and they will have to buy back to InMode and pay high prices for that. It's kind of some competitive advantage, but I will not say they have a big moat or a big competitive advantage. But they've been growing free cash flow per share, returning a lot of capital to the shareholders. And we have a quality score of 72. It is a really good company. I really like it in terms of the score. And it is a really great price. It is cheap, yes. It is a good business, yes. In terms of returns for the future, we can see revenues and earnings growth from this point. PE expansion, yes. They can expand their PE. Right now they are trading at a PE of almost 7. forward P of 9, so they could expand if they resume growth, do plenty of buybacks to support the stock price, and investors regain confidence. If they grow around 5 to 8% with these margins, they deserve a PE or forward P around 20 without no doubt. And they're doing plenty of buybacks. One thing I really like, even though in 2024 the stock was down, they bought back 6% of the company. And in 2025, we are still missing a fourth quarter report, but in 3 quarters they bought back 16.1%. With the cash they have in hand, they could buy back, if that was possible to buy back so much shares at the moment, more than 50% of the company. So with buybacks, they could increase earnings per share like 10% per year at these depressed prices. So, but is this really cheap? We will do our discounted cash flow for the next 7 years. It is an irreal company in terms of business risk, even though they have a very good balance sheet. But I would say this is a high risk investment. So for my base case, I will have to use a big margin of safety. So my discount rate for my base case will be 17%. I'm expecting them, after hitting bottom in 2025, to grow around 5%. In terms of future PE, they have really great fundamentals. It is a really good company, but I do not believe they have a big moat or a big competitive advantage that could protect their business in the long term. So I will assume a future PE of 17. And in terms of margin, I do not believe they could sustain 37 or 39% free cash flow margin. So I will assume something more conservative, 31, which is a very good margin. If they could sustain about 30%, it would be very good. But I'm trying to be conservative here. So with this assumption, I came with an intrinsic value of 30.6. $8 is just for the balance sheet, but overall we have to add the cash in hand. So the price right now would be $30, and InMode is trading under $15 per share, which is a 15% discount for a fair value that has already some margin of safety in that. So it is like buying 50 cents on the dollar, like you used to see Warren Buffett, Benjamin Graham praising in the old times, and usually you don't see that. But of course, if InMode is that cheap, that's because there are risks associated to this investment. So if that goes as we expect, we could have 20-25% returns in the next few years investing in InMode, but a lot has to go well, and it could be a big risk, of course. But at least when you look at the risk-reward situation, it is risky, but the reward, if that goes as expected, it will be very high. So that's why I like InMode as an investor for 2026. To wrap this up, InMode looks like a classic deep value play. You have a pristine balance sheet with half of the market cap in cash, providing a massive safety floor, and the valuation that price the business as if it's going out of business, which the fundamentals simply don't support. The risk-reward ratio here in 2026 looks incredibly asymmetric, but I want to know what you think. Is the market right to punish this stock, or are we staring at a 2x or 3x opportunity? Let me know in the comments below. If you enjoyed this analysis, please hit like and subscribe to MoneyJourney so you don't miss our next deep dive. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.